Hello and welcome to Global LPG Conversations, the Argus podcast where we cover the latest developments in LPG markets and prices. My name is Peter Wilton, editor of the International LPG Report here at Argus and manager of our European price reporting team. And joining me today is my counterpart in Singapore, Francis Go. Hi, Francis.
Hello.
So the last time we sat down together was part of a three-part podcast series we did globally, reflecting on the fallout of the initial ramp-up of the US-China trade war. I think at that time, tariffs on US LPG into the latter were ramped up to 145%, which was, just effectively an embargo on trade flows, really. But following the 12th of May de-escalation, after trade representatives of the pair met in Geneva, where they agreed to a 90-day walk back to just 10% on US exports to China. Since then, so how, Francis, have things sort of shaken out in the Asia Pacific markets? I mean, have we returned to sort of business as usual?
Yes and no, but mostly no, because we have seen in the last 3 to 4 weeks, spot trading remains patchy. We have seen that purchases may not necessarily be governed by financial logic, but by geopolitical concerns. Since bilateral tensions between the US and China remains high, many buyers in China still prefer to pay $10, $5, $10, $15 premium for non-US origin cargoes for peace of mind in case the pause on tariffs unravels before the 90-day is up. The Chinese market can broadly be described as being three-tiered, where there is a Middle East, African, Australian one, a US one, as well as a Canadian one, where the price disparity has fluctuated between $10 to $20, depending on various factors. Depending on the political mood, Chinese buyers can take US origins, but prefer not to avoid that risk, the trade war risk. Such as, 1 week in, we hear of a bunch of CP-linked deals for non-US origin cargoes, and the next week we hear of a bunch of AFEI-linked deals of US origins. And then increasingly so, Chinese sellers are seeing offers on a fixed price basis to China, which harks back to 7-8 years ago, where Chinese importers were less savvy with swaps trading instruments. I mean, as we await further trade negotiations to achieve success and tariff wars to be scaled down, I guess it is fair to say the worst is behind us, since we have seen prohibitive tariffs effectively cut off US supply to its single largest buyer, and the market had quickly rebalanced. So it seems that we have lived through the worst of times. Traders and importers have become smarter.
Yeah, well, yeah, quite. I guess a lot going forward is going to hinge on what comes out of the latest meetings between trade representatives of the US and China, currently taking place in London, where I'm recording today on the 10th of June. So far, it's been tight lips on both sides out of those meetings, so no insight gleaned as yet. But I wonder if we could just drill down, further into the Chinese market. I think listeners would be interested to get some insight into, what exactly is driving the demand for propane, because, globally petrochemical markets and margins are under some pressure. So are downstream prices holding up there to support these imports?
Well, after a period of volatility where term contracts between Chinese buyers and their suppliers had to be renegotiated, it appears that downstream petrochemical prices continue to drive propane demand. Market participants continue to monitor Chinese domestic propylene and PP futures prices to determine how much and at what price PDH operators are willing to pay for propane feedstock. Chinese propylene prices have fallen by about 8% in the past 2 months, while PP DCE futures prices lost about 6%. But even though each petrochemical plants may have their own cost-benefit calculations, but broadly speaking, propane import prices has corresponded to movements in the Chinese PP prices.
Right, sure. So it's still, eyes on those Chinese PP prices for how the import levels are going to be, as has been for quite a while now. And how does sentiment look going forward there? I mean, it can't be much fun navigating the current sort of geopolitical landscape, which seems to change, week by week.
Yeah, to say that the LPG market is fraught with uncertainty is an understatement. PDH run rates have surprisingly held up. It has fallen and rebounded and is currently at 66% last week because operators adjusted according to their downstream yields and cash flows. Some plants which also crack butane and naphtha would be in a better position than on-purpose propane units. The outlook remains bearish because of high propylene supply weighing on domestic prices. There is an estimated 3.2 million tons per year of propylene production capacity due to come online as new refineries and crackers start up. So the pressure on this PDH margins will prevail. But the LPG market is highly efficient, so supply and demand forces will reset prices very quickly.
Right, sure. Yeah, no, that makes sense. Quite some pressure coming from 3.2 million additional capacity coming online. I guess it's pretty clear how things are in China, as it stands at the moment, at least. But of course, Asia Pacific region is somewhat larger than just China, even if that nation is what's been caught in America's crosshairs so much of late. So how is the rest of the region doing? I mean, massive markets like India and Indonesia, for example.
Well, India and Indonesia have seen higher US inflows in the past 2 months because of the rerouting of US shipments via the Cape to cope with the loss of Chinese demand. Increased supply had weighed on spot premiums, so both of these CP markets have seen much lower spot premiums, CP value notwithstanding. As we enter the summer month, stock building by Northeast Asian importers, basically Japan and Korea, have also slowed compared to last month. The spread on US versus non-US origin cargoes has also come in a lot from, on paper from $130, $40 to $60. So the initial burst of spot demand from these 4 main Asian importers have also slowed. But as we move towards Q4, things could get interesting again. So stay tuned.
Yeah, no, I think you're right about the only thing that is certain here is that we've not hit the end of this this story just yet by any stretch. But for now, I think that pretty much covers how the land lies. So thank you very much for your insights today, Francis. And we'll be back soon with another edition of Global LPG Conversations on this very topic, no doubt, before long, perhaps just within days, actually, if something substantive comes out of the London meetings between US and China representatives taking place right now. So, yeah, all that remains for me to do is to thank all of our listeners very much for continuing to tune into the series. And please do look out for subsequent editions on all the major podcast platforms.